Hey, welcome to the show. Total Financial Solutions, Safer Money Hour. Folks, you heard about the Memorial Garden Tour that's coming up. Go to memorialgardentour.com, or sorry, memorialgardentour.org, and you get a chance to see exactly what's going on right here in your hometown station next May 1st. And I think you will enjoy everything that has to do with seeing what people are doing to their gardens right here in Santa Clarita. I enjoyed it. If you're an outdoor person, I think you will too. All right, we're going to continue with your place for news, talk, and information. It's Total Financial Solutions, Safer Money Hour. Okay, how do you use annuities for retirement income? You know, for a lot of folks, annuities are for some, it's a lifesaver. For others, it's a bad word.
Right.
For some, we've seen people say, I don't like annuities. You're like, oh, really? But what about? And they say, oh, well, by the way, it's also Social Security, by the way. Did you know that's an annuity? You give money and then they give you a payment. So, there's different purposes for every type of an account. I don't want you to think that one is better than another just because it has a name, but I do want you to understand one thing, and that is that every single financial product in the world does have a use for it. So when do you use this particular product and for what? Well, an annuity can be part of your retirement income without giving up the principal, without giving up the big chunk of money that you have earned your entire life. Look, there's some old-fashioned annuities out there, and there's the old ways that they used to do it. I'm not a fan of those, where you give them your money and they give you a payment, and if you die, that's it. They take all your money. That is not today's annuities. Maybe there's some out there like that. I just don't see them anymore. So how do you make sure that what you're doing is you're putting yourself together in a place to not run out of money in retirement? Because I think ultimately that is the most important part of this equation.
Well, I think to answer that question, we have to look at having multiple sources of retirement income, because really we spend monthly paychecks is really how it breaks down in retirement. We were used to going to work, trading our time for money, and maybe you got paid every week or every 2 weeks or even once a month. So why would that change just because you stopped working? You still want that paycheck to come. Maybe it doesn't come every 2 weeks, but maybe you do. There's different ways to set this up, and there's nothing saying, no rule out there that's hard and fast that says you can't have income from each one of these accounts. So using an annuity is, and we'll break down some of the different types that there are and maybe where the uses are, but an annuity really is just a stream of payments coming to you. You have an arrangement with a company that holds your money and they dole out the payments, giving you some of your money back and the interest for the privilege of having your money. And if it's done right, you can have it last for the rest of your life, and including if you don't spend all your money, have the remainder go to your beneficiaries. I think that's a really important and key part.
And did you know that annuities can be used to not have a guaranteed income stream by itself? In other words, it doesn't have to be that. You can say, I like the financial instrument. I like the idea that it never goes backwards, my income. I like that in an indexed annuity, I can go up with the market. I like the fact that if I go up with the market and I want to take some interest out, I don't lose my principal, because you can just take out the interest, right? You can actually modify any kind of thing that you want with the right financial product. But not every annuity is created the same. You have to know that. In some worlds, there are some annuities that are, in my opinion, not so good for you. And here are a couple of things I want you to watch out for. Number one, keep a lookout for annuities that are in the A category. You don't want to deal with annuities that are B rated or lower, like in the B plus. Stay away from those. Stay A minus, A plus, or A plus plus. That's kind of a group of 4 or 5 there that would give you an underlying security that the market is healthy. Meaning this: what is the reserve? What is the dollars that company has in their back pocket? What do they have in their account? In case something happens, financial catastrophe, how do we make sure that money is healthy and it's there? That's what that A rating does. It's the agency. It watches those dollars and keeps an eye open for it.
And one would beg the question, why would someone choose a B-rated company? Well, how would a company that is rated less on an A, B, C scale attract somebody? They normally offer a higher interest rate. And so what they'll do is say, here, put your money with us and we can give you this, XYZ guarantee or whatever the percentage is that they fill in, and you think that you're getting that rate of return. And a lot of times you don't even realize you're paying a fee for that. So there can be some pretty convoluted parts to it, but if you really think about it in the sense that working with the A-rated companies, they have a history of paying their policyholders out. That's a really important part. Arif touched on it in a great way. A history means that they've been through wars, they've been through economic downturns, corrections, whatever you want to call it. They've seen the best and the worst of our economy, and they typically will have a running history of at least more than 20 years. We like to see it closer to 100 years, and there are a lot of companies out there that are doing that right now.
So do you see that now? That's part of what you're looking for, is that safety and security by the rating. You want to make sure that they have the ability to pay out those payments over a period of time and various economic conditions. And number 3, you want minimum guarantees. Minimum guarantees. What would those guarantees be like? Well, if the stock market never goes up, if the economy, has a problem, all of that, how do we still make sure you're getting a 1 or 1.5% guarantee? That's what that money is for. That's where that number comes in, is that minimum guarantee. So it gives you that floor so that you know that no matter what, over a period of time, if the market never goes up, you still have a chance to get pretty good amount of interest added compared to losing money on the other side.
And a big part of this is to remember that, and you were talking about some of the negative connotations that come with some words for financial instruments. Annuity. Some people go, oh, and they cringe at that word. It's not like they used to be. They're not built the same way anymore. Look, there are a lot of products out there, cars, cell phones, you name it, anything that's been built in the past. What was the very first cell phone like? It was 800 pounds, and you could only call a 3-mile radius before you drop the call. I mean, I'm being facetious, but think about this. The first car, did it go 100 miles an hour? No, it didn't. Was it comfortable? Did it have great shocks? No. Things are improved over time, and the like happens with some financial instruments. Annuities are a great part of what I like to call kind of the set it and forget it type of income. If you don't want to actively manage how much money you're pulling out each and every month and making sure that you don't run out, because that's a big part of it in retirement, right? You spend your whole working life getting to retirement building and building and building and saving and sacrificing so that you can spend your money. And then what do we see when people get to retirement? They either A, they don't think they can retire, they don't think they have enough money, or B, they don't spend it. And how do you get away from that? Well, you have to have some instruments, I think, at least a part of it, be where it's telling you how much you can spend for the rest of your life without running out.
And that's important if you want that comfort, that safety and security. And a lot of us do. Some of you are a bit more on the gambler side. And ladies, usually it's the guys. Not always. We don't see it out all the time. But you do see it more frequently in men that have that desire to take a little bit more risk. We either made it or we lost it. We're rich or we're poor. We're up or we're down. And that environment of risk is comfortable for some people to live there. But for others, that is not the case. For others, we're not happy that way. We prefer to have the excitement be in our lives, not the excitement in whether or not we're going to get paid this month or whether or not we have an income. So there's a component to an annuity that transfers the risk of that guarantee from you or your skill set in managing the stock market or whatever else you might be putting your money into, and pushes that over to the trained people in the annuity world. Now look, there's a couple of trade-offs. There's no free lunch. You know that. What are the trade-offs? There is a time commitment. That means if you're going to pull all of your money out prior to the end of the time you select, could be 2 years, 3 years, 5 years, 7, 10, on and on, then you will pay a fee if you're going to take out more than what is called the free withdrawal amount. So what does that mean? Some allow you to pull out just the interest. Some allow you to pull out 10% or less. So if you want to take out 10% or less each and every year, and that's enough to live on, fantastic. That's perfect. No fee, no penalty. You might pay taxes if it's an IRA, but you're not going to be paying any penalty to the company. And as long as you're older than 59 and a half, you won't even pay the 10% penalty for the IRAs if you're pulling money from there as well. Okay, so keep in mind that as long as you are within that time frame, and look, I would never say put all of your money here. Of course not. You would put some or most that you want to keep safe. This would be a good place to put that. The second catch that makes this work, very simply, is there is a maximum gain, or what's called a cap. Now, the caps could be anywhere from 3% to as high as 20%. We've seen them, depending on how they calculate the interest and the other things with it. But this is important. in your world, as long as if the cap, let's say, is around 10 or 12%, if it's 12% and the stock market goes up 4, then you get to go up 4. If the stock market goes up 8, then you get to go up 8. But if the stock market goes up 12 and that's the cap, that's it. That's the most you're going to receive. If the stock market goes up 20, 30, 40, what's the most? Yeah.
12.
You have to be okay with that. So our clients, when they come to us, we know you're going to have somewhere between 0 and, let's say, 12% return every year. The average might be between 2 and 5 or 3 to 6, something like that. And if at the end of the day, the stock market does 35%, it's the best year in 20 years, you're not going to receive that. But you don't lose. So that's another component that works very nicely.
Well, I think looking at this from a plus-minus standpoint, you want the math working in your favor. If you go up in that example that you just gave, Arif, 35%, but that's money that could be taken away from you tomorrow or next month or next year, because that's not guaranteed if it's sitting in a market. I mean, that's the way we all understand that, right? We know that we're gambling or we're taking a market risk, right? So when that happens, and if that market pulls back or corrects, or that value, in simple terms, if your money goes down in value, that 35% was nice, but what did you do? What did you do about it? Did you spend it all? Did you park it somewhere for a rainy day? Typically, that's not what people do. And look, we're all a little bit greedy. Everybody wants a little bit more interest. They want to do a little bit better than the next guy or gal. But if you think about it, like I mentioned, from a plus-minus standpoint, if you go up 3 or 6% and you get to keep all that, and then next year you make another 3 or 4%, and you get to keep all that. See where I'm going with this? You do that over 5 or 10 years or whatever length of period of time that you've chosen for that specific annuity, for that time commitment, then really what was the harm there in making a commitment to make some interest that you didn't have to lose or worry about if you were going to keep it or not? So these are all important things. And remember, it's a component. It's a part of your retirement portfolio, your income portfolio. You're going to have different types of accounts potentially. And some people don't. Some people just say, look, I want to have a 5-year annuity, a 7-year annuity, and a 10-year annuity. I want different income streams kicking in at different times because I want a pay raise in retirement, darn it. I don't want to have a fixed income. I mean, that's what we hear a lot of seniors and retirees talking about. They say, oh, everything is, the woes around the fixed income. You can earn interest in these accounts. You can have your income go up, and you can have income kick in at different times of your retirement, which I think is pretty nice.
Hey, keep this in mind, guys, as we're going to take a break in a second. Keep this in mind. As you are planning for your retirement and an annuity is a part of that, you need to search for somebody who's helping you, who has experience in this field. You want to work with us, that would be fantastic. But you don't have to. You can find, if you say, oh, I want to work with my financial professional I've worked with for 30 years. Well, look, we'd love for you to work with us. But if that's your choice, make sure that, number one, they're licensed to do this. And number two, make sure they have choices. You don't want it to be one of those big companies who has their name on the side of a building in New York City. Who says, oh, we have one size fits all. Everybody walks in, gets the same one. That's not helpful. It's not what we do, and it's not what somebody who is working in your best interest should do. Because rarely is the name on the building the same as the one that might be appropriate for you. Okay, so make sure they have options, not just a one size fits all, because it's not helpful to solve your financial concerns. When we come back, we're going to continue with your retirement planning. How do you plan for that? How do you prepare? A couple of good choices, I think, when we come back on Total Financial Solutions, Safer Money Hour. You can go to hometownstation.com, click on Total Financial Solutions, and it sends it over to you to our website. Or you can go to TFS, stands for Total Financial Solutions, TFSwealth.com. We'll be right back. I'm Arif Halaby. Hey, welcome back to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby along with Jeff Girard. We're talking about your family's finances, helping you get out of debt, manage money, of course, plan for your retirement. What does that take into consideration? Well, look, before we continue, I want to give you a bit of an update. It's a little old. It's a few days old, some of this information, but it's new to many of you. Because MetLife is so large in the disability world, both through your employer and people purchasing it outside of their employer, I want to give you a little bit of an update on their disability insurance. MetLife has suspended individual disability insurance sales. Now, what that means is they will suspend their individual disability sales effective September 1st of 2016. So still 4 or 5 months away. But it will be the final date to submit business for brokers and agents that are in fact selling it, meaning you can still keep it if you have it. They're still going to be paying commissions to your agents. That means your agent should continue to support you and provide service. They're going to continue to provide sales and service support to you as a customer. So if you have a claim, they're going to continue to work through that. But apparently, and we expected this because it happened in the late 90s when I was selling long-term care insurance, we saw that Travelers at the time, which is who we were selling their long-term care, started having mispricing, meaning they were such a great deal, Genworth, amazing. All of a sudden, we started seeing across the board that they were suspending sales. And part of the reason is because they didn't price it properly. Here's what that means. That means you built your whole financial retirement life on having some protection in case you have a disability, have some protection in case you pass away for your family. And what happens when all of a sudden the companies change their mind? Well, what takes place is, in this case, they are still going to provide service and sales. That doesn't change. They're just not going to sell new business after September of 2016. So what does that mean to you? Not a whole lot, but just keep your, unless you are a MetLife client, but keep your ears open. There may be some changes next year. They're trying to figure out how to price it. They may be raising rates. If it's something you want, you can get the policy sooner than later. You might want to do that. If you've been on the fence, maybe we'll keep it, maybe we'll get one, maybe we won't. Now you know if it's something you want to actually apply for and hopefully receive, do it sooner than later. Any changes of this sort will benefit the company as they get time to reorganize some of their conversation. But we were just covering, right? I found this out during the break. We were just covering some of these buildings like that have their names on it, like the New York Life and the MetLife. Just because they have their name on the building doesn't mean a whole lot, right? Their product is a wonderful product if it's healthy and from a good company. But if it isn't, I don't care whose name is on the building.
Well, I think something that comes to mind for me is for the folks that are either going to lose a job or change jobs, and they think, oh, you know what, I had some benefits like this disability insurance through my employer. I had a group plan. That's great. That's a separate division. We're talking about individual sales, right? So if they're suspending individual sales and you had a plan through work and you think, that's okay, I'm just going to let that lapse. Well, I don't think I can do anything about it, right? Leaving a job, I'm just going to go buy one on the open market. If you were planning on a certain price or a certain dollar figure that you were paying that same type of insurance, you may not be able to get that, because if a big company like MetLife is getting out of that business, that means that either rates have to go up because it wasn't as profitable or it just wasn't profitable. So got to think about that. So for me, if I was leaving a job, I would look at portability of some of my benefits. That includes your life insurance, if your employer was helping through a group disability program. So all of those things that you think go away when you quit your job, you might be able to turn those into individual. So take a look at that before you switch a job and leave some of those benefits behind.
Okay, folks, I'm going to continue with annuity sales. Let me give you kind of a general update here. In 2015, indexed annuities showed a total growth rate of 7%, fixed annuities 7% over the previous year, fixed indexed annuities 13%, meaning both of those are moving up from the previous year, from 2014 numbers. But variable annuities, which is by far the big granddaddy sales-wise of them all, variable annuities have retracted, meaning people are not putting in new money into those as rapidly as they are the others. That's an important part to your particular retirement accounts, because where's the money flowing? How does that protect you? Well, we're seeing some changes as people are really going more towards the guarantees, I think, Jeff.
You're right. And a lot of what we're seeing is people not being really satisfied with the amount of risk that they're taking in terms of the reward that they're receiving. So if they're taking 100% of their money and putting it at 100% risk, and they're able to make, 7, 8, 9, 10%. That's great. But if the fees are 3.5%, which is what we're seeing as a pretty solid number for fees, that's just before you even get to take a swing at the ball coming at you. You have to pay 3, sometimes 3.5. We've seen even more than that, but that's about the general rule there. And then you're at risk for what? For money that you can gain, but you may not be able to keep it all. So there are some different components to variable annuities, and I think they're really complex when it comes to what the benefits are for you. They have a lot of bells and whistles, but people are looking more towards, like Arif said, those guarantees, the ability to make money like a stock market index would. Get some of those types of returns where you're not having the money parked under your mattress, or sitting in a bank. I mean, because we know that that's not really paying much right now. So where's that in between, that hybrid sweet spot? Do I park it under the mattress, or do I go put it, on the table and gamble? Well, that in between can be an index-linked annuity.
Those index-linked annuities give you those guarantees we covered last time. But what about the payout options? What about when it's time to take money out? There's usually a couple of choices. Number one, you can pull out each and every year, usually after the first year. Some of them allow you to pull it out the first year, but anywhere between 5 and 10%. Now, how do they calculate it? It's a little bit all over the map, meaning there's a couple of different choices. It can be 10% of just what you put in, so your contribution, however, over the next 3 years you put money in, it's 10% of that number, regardless of what it has grown to, okay? So that's one option. Another one is 10% of the balance. So as you put money in and then it's grown and then interest, 10% of that number will probably be higher than 10% of what you've put in. So it depends on when you're going to take out the money, and which account is better for you, because they each have different features. So you might want some that, I don't really need more than 5%, okay? So these features of withdrawing money still preserve the principal for your children or grandchildren or spouse or whoever you want. Meaning, if you're just going to take out the interest, then what you put in never goes away. Not because of fees, not because of the markets going up and down, no reason whatsoever. Or you can say, I want a guaranteed number each and every month. I don't care if I lose some of the principal, doesn't matter. I want to know that I have a dollar figure coming in on the first of each month forever, as long as I live, as long as my spouse lives. And that is a great way to build guarantees, but still, even though that's the case, you still have whatever's left in that account goes to your beneficiaries after you pass away. So we're starting to see a lot of changes in the market. In fact, we're going to be sending out a letter to folks in an email, because there's some talk that one of the accounts that offers a 20% bonus may be going away because interest rates are changing. So keep your eyes open. We don't know if that's going to be something that's temporary because it was a recent increase. They may be going back down to where they were before. So look for a letter coming out from us here shortly.
Well, let's talk about a bonus for a second. Sometimes annuities offer what's basically what we call a bonus. It's really just prepaid interest, right? So if you have an account that maybe had lost some money, or you're looking to maybe have a head start and get closer to a particular amount of income, you might use an account that offers a bonus, because what that does is, just a quick example for quick math, if you put in $100,000 and this annuity offers a 5% bonus, you open up that statement the next day, or you get that policy in your hand after you've made that deposit or that transfer, your balance is $105,000. That's the number that you're starting to earn interest from, not from the 100, but the money that they put in up front. So that's the bonus. And what typically happens is you generally make a little bit longer of a commitment. So let's say that there's an account that you would put your money in and the commitment was for 7 years, right? That might be just a plain vanilla indexed annuity, and you say, okay, great, I can make money when the market goes up. If it goes down or stays the same, I don't lose. Fantastic. In 7 years from now, I might take some money out. I might take some money out along the way, no problem. But if you take that 10-year account, let's just say, for instance, and they offered a bonus of 5%, you would start earning interest on a much higher number. And that's really attractive for a lot of folks, especially, like I mentioned, if they've lost or they're trying to get to a particular amount of income down the road. So you make a little bit longer of a commitment sometimes, and then they give you a little bit more interest up front, which is kind of nice.
And as they're breaking down these accounts, remember you can carry them on, meaning you can actually take these dollars, set them up so that they continue past your passing and to the next generation. And depending on the account, you could have it actually go on for years and years and years after you pass away to fund a charity, grandchildren's college. You can use it to fund a great-grandchildren's college. You can have your own mini scholarship fund where all of your children or grandchildren come to this particular account each and every year, and they get a portion to pay for their college, and you can lay out the groundwork, whatever you choose, so that your family has an opportunity to not have to go into student loan debt. They have an opportunity maybe to start a small business. So you may have a particular fund that you use this for that is specific so that your grandchildren could start small businesses if they want to, provided certain criteria are met by them, and you can have those dollars doled out in future payments. So that is important to know that that type of mechanism could be used, and this is a part of it. You would speak with your estate planning attorney and kind of lay it all out, but that's a good option as you break down some choices.
Well, it's really nice because you have the flexibility on the back end to name any beneficiary that you would like. The beneficiary is the person that would receive this money that's in this annuity if you pass away, if and when you pass away. So having some of those provisions and are nice, having the groundwork laid ahead of time, that's really the key to it. Arif, let's talk about the monies that can be used to fund annuities. What are we seeing as most popular when it comes to the money that's going into annuities? Because I know there's several different types of ways to put money into this type of account.
You know, we have seen people take old retirement accounts where they used to work, take those dollars, and then continually, as they're working different jobs over time, building up their retirement, maybe they've built up a 401k, taken money out, build up a 401k, taken money out. And I don't mean take out and spend, but I mean take out and roll over into an IRA. Because if you've left a job, why would you leave your 401k behind? For a lot of people, they don't realize that they have fees associated with that type of an investment, and those are not fees that they want. And in that particular case, you can take some or all of those dollars and roll them into an annuity. Now, that's nice, but what about while you're currently working? Well, that's different. Sometimes people say, but you know what? I have built up a savings account, and my 401k is part of that, and if I need it, I borrow money from it. Great. Then keep that money, keep up to that amount in there. Here's a good example. With your retirement account at work, usually they say you can borrow 50% or $50,000. That means that once you hit $100,000 in your current 401k where you're working, because you can only borrow if you're still employed by that employer. So once you hit $100,000, there isn't any more benefit to have money there to borrow, because you can't get access to $50,000, any more than $50,000 of it. So then what do you do with the difference? You take those dollars and you put them in your own IRA if the company allows for an in-service distribution, an in-service rollover. And in most cases, you can even speak to your company, your human resources director, and ask them if there's a way to add that if it doesn't exist. In most cases, it's a single letter. We have it. We'll send you the letter, or we'll send it off to your HR director directly. So that gives you, it's a real simple request, but it gives you access to those funds to roll them over, to not pay penalties or fees, and to get those out of the up and downs of the market and whatever fees might be associated with them.
And another important part is this rollover is not a taxable event to you. It goes from company to company. A 401k to an IRA, that's still a pre-tax account on this side. And what you've done is now taken an individual control, preserve the tax status on it. So you'll pay taxes later when you take it out, or at least it will be subject to tax. You have to think of it that way, because it's money that you never paid taxes on in the 401k. It went up and in, it goes across, and now when it comes out to you, you've got to answer to Uncle Sam on that. But the nice part is you don't shut down your current retirement plan at work with this in-service distribution.
Yeah,
you're
Jeff,
taking a part of it out.
Well, you still get the matching. That's key.
Right. So it's an account that you're still adding to at work. You're getting that match provided your company offers that. So if they're giving you that incentive to put money in and they're matching your dollars going in and you've taken some of that back out on the back end, you're still putting in and getting the match. Oh, and by the way, if you roll it over into a bonus account, do you get another match on this side?
That's right. And
yes,
a bonus is a matching program that the insurance company sets up with you. So, for example, there are some that give a higher matching, but only for the first year contributions. Others that might give a little bit of a lower matching, but for 3-year contributions. And there are still some that give maybe a little bit lower than that, but for lifetime contributions, depending on your employer, how you're putting money in, right? These things all can increase the amount of money that is in your account, all from other people's money. You want that. You want the employer to add money, you want the investment to generate money, to generate interest, and the new company to put matching. That's part of the game there.
And for a lot of folks that don't have a matching program at work or even a retirement account or a plan at work, they can open up an individual retirement account. They can use these types of bonus annuities for those ongoing contributions, and you just fund it during the bonus period. Maybe it's a 1 year or a 3 year or a 5 year, like Arif was talking about. You start putting money in, and at the end of that window, you still work, you still want to match, and you still want to put money in, no problem. You can open up another one. You can have multiple annuities, and it's probably best to take a look at something like that where you're spreading out and you're not putting everything in one basket, as we've talked about before.
And remember this, your family's future depends on you making decisions that are not built on risk unless you're familiar with everything. Ask anybody that takes a significant risk, right? You see motorcycle drivers or snowboarders that flip upside down, and skateboarders that do some crazy things, and financial people that take their retirement accounts and everything and they invest it in a small business. The ones that succeed in all of those adventures do so with massive amounts of preparation, planning, and practice. If you are not doing that, and yet you still think you're going to achieve the same results with that same level of risk with your retirement account, and you don't have massive amounts of practice or preparation or knowledge, and yet you still close your eyes and you put money into the retirement account to the mutual fund and you say, well, that must be going up because the market goes up, and you don't realize that that's not really what happens and that the system is built differently, then you remember this. Your family is not counting on you to take huge risks and win. They're counting on you not losing and not making big mistakes. There's places to take risks where you're good, where you're planned, where you've prepared, where you've created the environment to have a better shot at winning than a stranger off the street. No more could I come in and do your job and expect the same level of success than you could come in and invest in your retirement money and think, oh, well, I'm going to beat Warren Buffett. Come on, this is your financial future. Be very careful with it. You want to get a hold of us at tfswealth.com, 753-9683. That's our phone number, 753-9683. I'm Arif Halaby. That's Jeff Girard on your place for News Talk and Information, AM 1220 KHTS.